Okay, welcome back, Jordan, Michael, and everyone here. Okay, I think this is it today. Um, so I'll record this and post it on the YouTube page. Hopefully those are helpful. Um, okay, so the assignment 4 is due today. Um, any questions on that assignment? Most of you have already, you can have if you need some tech issues.
Yeah, I'm gonna submit it to you today.
Okay,
We did the
yeah,
most.
but Farrah wasn't here. So she, we pretty much did, I guess. Yeah, it was more of just a. Okay, so for today, if you notice, it is week 10, April 13th. I posted another topic and I posted our project, our first project, so we'll go through that. And if everything goes to plan, that'll be due in 2 weeks. So you got 2 weeks to do it. It probably shouldn't take you that long. And just think of it as it's 15 points, so it's essentially like two homeworks. So I wouldn't spend 2 weeks straight on it, but spend like at least more time than you would on a normal homework. Yeah. Um, but we'll go through that. Okay, so there's uh, a model I want to incorporate, or I did incorporate into the project, which is just a form of a simple regression, but we haven't covered this specific topic. But I like to use it for research projects because you can use your own stock and kind of play around with it. So, has anybody heard of the CAPM, capital asset price? Yeah, like if you know the term beta in finance, that's where this comes from. Yeah, it's a pretty simple model. I'm not sure how useful it is, but it's a very easy model to implement. So I like to use it for some projects. But I have a quick run through video I'm going to show you, and then we'll look at an example, and then I want to spend a good amount of time going through the research project so you're familiar with what to do. But um, what we did last week for the first homework is a kind of a start to the research project. All right, so and what was I going to do? Oh, video.
The catalyst often called or show here that shows the relationship between the expected return of investment and market risk. Better understand that the example and how to use. This is the formula. And if you know
There we go.
But for the rest of us, let's break it down to try to make it a bit simpler. So there are only three inputs that go into CAPM. First is the risk-free rate. We're going to use the 10-year Treasury note, and as of now, it's September of 2018. The 10-year Treasury note is about 3%. Next, we have beta. Beta looks at the relationship between our investment and the market. For our example, we will use the stock. So for us, beta looks at how the stock moves compared to how the stock market moves. The market, by definition, gets a beta of 1. So let's use Apple stock so we can see an actual example. So Apple's beta is 0.99. Now this is mighty close to 1. So what does this tell us? Well, it tells us that Apple stock acts very similar to the market. So if the market's up 1%, well then Apple stock will be up almost 1%. More exactly, it should be up about 0.99%. Same is true on the downside. If the market goes down, Apple stock will be down just short of 1%. And just to see how this impacts things, let's throw a second stock in. Right now, Facebook has a beta of 1.2. So if the market moves up or down 1%, Facebook will move up or down 1.2%. The closer the beta is to 1, the more the stock moves like the market does. The final input in our formula is the expected return of the stock. Now, coming up with this number isn't always clear. Some research companies publish what they expect long-term market returns to be. You can also use a historical average. For our case, we're going to use the average of the past 10 years, which is about 9% per year. Okay, so now we have all the inputs. Our risk-free rate is 3%. Beta for Apple is 0.99, And for Facebook, it's 1.2, and then we have the expected market return of 9%. Okay, so let's plug these numbers. So R is the risk-free rate. So here we plug in 3%. This symbol here, this is a great symbol for beta. For Apple, we have a less than 0.91, but we can put Facebook's formula down, and there we will put 1.2. Then in the parentheses, we have the expected market return minus the risk-free rate. We call this the market premium. For the expected market return, we're using 9%, and for the risk-free rate, it's the same 3% that we're using over here. Now, suppose it's the horizontal bar above the R right here and here. Well, that bar indicates that this is an estimate. So now we know we're using an estimate of expected market return, and that will give us an estimate of the return of this asset. That's what the lowercase a stands for. And over here, N, that stands for the market. So when we calculate these, we end up with 8.9% for Apple and 10.2% for Facebook. Now, don't forget, the only difference between Apple's formula and Facebook's formula is their individual beta. So how can this be used? Well, one way you can use, Kevin, is to use it in calculating the WACC of a company. WACC is short for weighted average cost of capital. And that WACC can be used as a discount factor to value a stock in something like discounted cash flow.
Okay, this part we don't actually need to know. That was the gist of it. Um, and so what all we're it looks maybe more complicated than it is. But all we're trying to do is see if a stock of your choice is more or less volatile than the market average over a certain period of time. So, like, and that would mean like, yes,
Volatile, so it would mean like good or bad.
good and bad. I mean more risky. So
Okay, so
if it's more volatile, you have a higher chance of making it big, but you also have a higher chance of losing. So it fluctuates more than the market. So it could mean good. It could mean not good. Yeah. So that's all we're really doing. So we're going to set up a simple regression where whatever stock you choose, we're going to get and this complicated term is just the returns over the risk-free rate. So essentially, the risk-free rate is buying a government bond. And if you buy a government bond, you're assuming they're going to pay their debts because they've never not paid their debts. And so usually almost always those returns are lower because they're only going to give you a few percent. They're actually higher than they used to be, but for a good period of time, they were like 0% or 0.1 or something like that. And that's because interest rates are so low. But if you want the safest return, you should buy a government bond because they're going to pay you the bond payout at the end of the term. So it's not going to be a very high return, but it will. I mean, in the history of bonds, they've never not been paid in the U.S., so we assume that's a risk-free rate. Okay, so what your stock or what the market makes uh, in excess of the risk-free rate would be the return you get in addition to just going safe. So you want to see if your stock's return over the risk-free rate is correlated with the market, which it should be because it's part of the market. And then this beta will tell you, is my stock more or less risky compared to the market? And that's really the whole story. So you don't have to memorize this whole equation. You're going to implement it, but that's the gist of it. It's just there's one X variable, which is the market returns over the risk-free rate, and there's one Y variable, which is your stock's returns over the risk-free rate. And this RF is just the intercept. That's not gonna that's meant to determine like the risk-free rate on the y-axis, but it doesn't always come out like that in practice. Okay, so that's the gist of the model. We're going to work through some examples. Any questions on just what this is y, RA, and x is RM minus RF. This whole term, yeah. And beta is like your coefficient. And then yeah. Mhm. And the RF is like the A or the intercept. It's just the terminology. Good. Okay. Excellent. So that's the general idea. Um, I put some examples here, and I don't really want to go through all these too much, but if you wanted to do more practice, just making sure you got it right, you can look at these. But if you open up Cap M examples under week 10, this is not required. We're just going to kind of look at it. So I have 4 examples from previous exercise. I like to use as examples. And so really what you're doing in practice is, if you look at the spreadsheet, there are 4 separate stock returns for a period of time for Ford, for General Electric, for Microsoft, and for Oracle. And this is essentially the equation I just showed you, which is the y variable for Ford, for example, would be Ford's returns over the risk-free rate as a function of some intercept, and then the beta is the coefficient of interest, and then the y variable is the market return minus the risk-free rate. So these are the exact same terms I showed you. And then there's an error term, but that's estimated, but not, you don't really have to worry about it. Okay, so if you were doing this as an exercise like we did before, you would kind of get the results, get a screen cap of your results, interpret the R squared, which you know how to do by now. And so the R squared would be explaining how much of the returns over the risk-free rate for your stock you're explaining. The beta coefficient is the important thing, and that's the volatility of the stock compared to the market. Okay, so when you hear the term beta discussed in finance, this is the exact same beta that they're applying. Okay, and then what you'll see is that like a coefficient, you're probably not going to get a negative coefficient unless something's weird or wrong. But if that comes up, we'll address it. Most likely, you should get a beta coefficient that is. We're about to get. Yeah, I'm just setting up the problem. Yeah, yeah, right. I'm about to do that. I'm trying to show you like what we're doing before. So when you get the beta, you want to compare the beta to 1, because a beta of 1 would mean it moves like a 1-to-1 with the market. And so if it was 1, that means every time the market goes up, the stock goes up. If it's bigger than 1, that would mean it moves more, like it's more volatile. And if it's less than 1, that would mean it's less volatile. So there's a simple way to compare it. One is um, one is how the market moves. It depends what you mean by good. Then it's less volatile, which means it's safer, but that means it fluctuates more. No, if you're a risk taker and if you're hoping for a high return, then go bigger than 1, but you also have a good chance of going less, right? If it's more volatile, that means that you can get a big payout or you can get a low payout. Yeah, those would be like 0.2 or something. Yeah, yeah, you're right. Something like Bitcoin would be like 2 or 3, because who knows what's going on with that. Okay, so that's the idea. And so it's the same idea for these other stocks. And to show you the example, CAPM example is finished. Okay, so this exercise is already done for you, but you're welcome to, try to replicate the results for this, or you can do it in your project. But this is there's a lot of variables here, but I don't know what happened to the date. That's weird. Um, let me, I might have auto formatted the date. doesn't really matter, but there we go. That's better. Okay, so this piece of data, yes. Uh, Highlight, yeah, because I messed it up previously when I was formatting it. So I made the date column a number, and to turn it back to a date, you just select the column, and under Home tab, Format cells. Okay, and then under the category, you want to choose date. Okay, so this date or series of data is from January 2002 to, I changed the category to date. Yeah, it should have already been like that. I had messed up the formatting. So this is monthly data from January 2002 to April 2013. So this has already happened, but I'm just showing you the data set. So the this is the market. So this is the S&P, the the price of the S&P 500. All right. Okay. And then this would be the returns. And by returns, I mean just um, the percent change from one month to the other. All right. And you could do it as uh, a natural log term. I'll probably show you the other way because uh, I think it's a little more intuitive than throwing logs in here. So the way I did this before was to do what's called a continuously compounded return, and that's just a natural log instead of doing a percent change, but it's almost the same. So when we do it, we'll do like um, when this goes up to this, then what's the percent change? So it's essentially like this minus this over the original. So it's just like the percent change for it. So the 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 returns of the S&P, it see how it went down. So it went down 2%, it went up 3%, and these are all the basic percent changes from one month to the next. So you see when it goes down a bunch, goes down 11%, goes up 8%. So okay, and then this column, ER S&P, is the excess returns of the return compared to the risk-free rate, which in this case is a 3-month treasury bond. So if you just look at what the formula is, it's just the return minus the risk-free rate. Okay, so if, and in this case, the return is negative, but let's look at this one for better context. So if the return was 3.6% and the risk-free rate was 0.15%, then in excess, it's just subtract the 0.15 because you get this risk-free, and then what you got from the stock was above that 0.15%. Okay, and then you do the same practice for the stocks. Like here's Ford's stock price, here's Ford's returns, like percent changes, and this is Ford's return each month compared to the risk-free rate. And then what you would do is, I have a section here called values only because it's a little bit easier to look at. So if we're looking at just running the regression, all you're doing is running a regression of the excess returns of the stock as the Y variable, and then the returns of the market as the X variable. So for your project, you're going to get um, a column for excess returns of the S&P and a column for excess returns of the stock, and that's all you're going to need, just 2 final columns for that part of the project. Okay, and then what you would do is I already have the results here, but for example, if I wanted to run the regression for Ford, I would just do what we've done before. Data tab, data analysis, regression, okay, The Y range is whatever stock you want to look at. So we'll start with Ford. Okay, B1 to B136. And the X range is always going to be the excess returns of the market, which for our practice will be the excess returns of the S&P. So A1 to A36. Okay, and labels. So our X variable is the returns of Ford, excess returns of Ford stock, and the Y variable is the excess returns of Ford stock, and the X variable is the excess returns of the market. And we usually hit labels so we can see those in the output. And if I were to hit OK, we'll get something like this. And I'm just going to format it so we can format cells, numbered, comma, okay. And then if I do format autofit column, okay. So this is the beta for Ford, all right. And this was the so what you would do, yeah, the coefficient is beta, right? Yeah, the coefficient is beta. So the coefficient is beta, and this is what you're looking at. So um, because that's a 2, that essentially means that yeah, it's like um, twice as volatile as the market average. So what you would normally do in practice is take a 1 and subtract 1 from, so our coefficient is 2.03. We're going to minus 1 for 100%. And if it was exactly with the market, 1 minus 1 is 0, it goes with the market. Okay, but in this case, 2.03 minus 1, yeah, equals 1.03. So, and you would interpret that um, basically in percent terms. So in percent terms, that would mean, now there's two ways of interpreting it. If you want to be more dramatic, like you would see in like, the news or NPR, you would say this stock is 103% more volatile than the the market, which is true. Or you could just basically say it's double. So double and 100% are the same thing in math-wise, but if you're interpreting it like as a percent term, 1.03 is the decimal percent. So move the decimal 2, and that's 103%. So the full answer would be Ford's stock was 103%. Where's the percent? More volatile than the market average. And that's it. So, and then if you've got, let me show you an example where does that make sense? Okay. And if you looked at the data, you should see that Ford stock is jumping around a lot, which it is. Look at this. It's up 10%, it's down 18%, it's up 33%. So I don't know what's going on with the Ford stock, but it's volatile means it swings a lot more. So it's up 20%, it's down 20%. So it certainly is, if you look at the regular market, it's swinging a lot. So depending on what you're interested in, you could buy the stock and try to, keep it or sell it when it's up. But there's an equal chance when you're interested in doing that, it's also down 15%. So it's volatile, meaning it goes up and down a bit more than the market average. Okay, now if I were to, and so I already ran the other ones. So this was Ford, roughly twice. So GE, General Electric, was a 1.35 beta. So subtract the 1, and that's 35% more volatile, right? And again, you're comparing everything to 1. And if you got one that is, oh, so we did get one. Microsoft came out to pretty much even. So if you get a 1, which is unlikely but possible, that means that your stock moves exactly with the market. Okay, and then Oracle, and none of these, like, I wanted to show you one less than one, but we didn't get there. But let's say that, Mhm.
When you do the graph, like get the one equation, so you took forward. What do you take?
Oh, so from the data?
Data.
Yeah, so we took, yeah, I like to I like to just set it up and then make a separate tab where I'm doing,
Okay, so the big gun we have
yeah,
sell that.
S&P.
Okay, sell that. Okay. So you take those things, right?
Yeah, you take ER S&P and ER Ford.
ER.
So this ER S&P is the excess.
And the variable.
Yeah, variables.
Okay. What is that? Okay. You take the ER. Okay. Oh, you from okay from there. What do you use for that?
X
X the board.
X no X is ER S&P,
ER.
and then Y is Ford. And then if you wanted to do it for General Electric, now General Electric is Y, and but this is always X. You can see that. So you're basically going to do this just once for whatever stock you choose. For that,
Yeah, and if you also follow the X and the 40 is Y, or if you have to X plus Y, then whichever I want.
yeah, that's correct. Yeah, that's right. Yeah. Yeah. Well, you need two of them, but you need the data to get to that first. So first you need, what?
We choose the data from there, right?
No. This is just an example. We're gonna get our own data.
Oh,
Yeah, I'm gonna show you how to do it. But the reason why you need to get your own is because it depends on the range of your stock data. Because this is 2002 to 2013. That's 10 years ago. We're moving on to new stuff. So you're gonna have to get for your stock uh, the S&P prices and the stock prices, and then convert those to returns and excess returns. And then I'll show you how to get the risk-free rate, which is just the 1 month return on a government bond. So when you do the spreadsheet, you're not going to have all these other terms. You're going to have like this part, and then just one term for the risk-free rate. And then, okay, so let me see if I can just give one example. If the beta were to come out to like, let's say the beta just hypothetically was equal to 0.65. Let's say that was the beta. Okay, you're gonna do it the same way and be like, yeah, right, 0.6, yes, equals 0.65 minus 1. So what does that mean? So what does that mean? I know, but yeah, 35% less volatile. Yeah, exactly, 35% less
So anytime you see a negative, that's 35% less fall.
after you compare it to 1. Yeah.
I think compared to 1.
Well, see, all of these,
Oh, okay, I got it.
yeah, anything less than 1 is going to be like, this one's only 35% less because it's 0.65. If it was 0.6, it would be 40%. Yeah. Now, there is the rare case you get a negative beta, then we'll have to deal with that later. That shouldn't be the case, but it is possible. I'm not sure what that means. But. Okay, so that is the idea. And this was just an example to show you the idea. And then in practice, you're going to set this up for a stock of your choosing. And I'll walk you through it, but if you get the general idea, it's really not that complicated. The hardest thing is just setting up the data. Okay, once you get it to this format, it takes a minute. Okay, so I'll leave that one up there for in case you want to practice um, after you start working on your project. Um, but this is just a historical example to kind of set up the idea. All right, and so when we get to the project, you're going to choose your own stock. You're welcome to choose any. The only ones you can't choose um, are Google because we did that one as a class example. And I think Chris chose his own stock, but it was something weird.
Yeah,
Okay.
he did.
So we'll see if he wants to stick with that. Okay.
But can he choose Google since he didn't do it?
No, Google's out.
Okay.
Google's now my example to show you. Yeah. Yeah.
I was
Google's-
just,
Yeah.
I'm not like, hey, you get
Yeah. Anything but Google. ABG. Okay. Um,
So pretty much I can do Disney for
you can do Disney.
example.
Yeah, well, there's the project, I'll go through it. I have an assignment. There's like 3 or 4 parts. Um, this is one of the parts. Okay, so I'm gonna, hey, any more questions on this before I close it for now? Yeah.
All this data, it's only one from forward, so all of that is like stuff, right?
Yep.
In one spread.
Yep.
That's
Yeah, I put them all together so I could do the analysis.
okay.
Like the exercise was set up to run 4 of them, and it's easier just to line them all up.
Okay.
Yeah.
So, yeah. Number.
Yeah. Okay. All right. I'm gonna close this. Okay. All right. How about we take a look at the project? Yeah. Yeah. And so you're,
Oil seems to be for the troll. Well, no, not right now.
yeah, how about, I don't, yeah, you're welcome to choose anything. Whatever happened to the GameStop stock? Is it still around? I wonder if that, it might still be around, but I don't,
GameStop?
yeah,
Holy
it is still around.
Everyone made that money, it just sort of nosedived right to the ground.
Yeah, that was weird.
Yeah.
Of course, sure.
Yes.
Okay, so we went through the CAPM. Here's the examples. Here's the video. This is just the link to get the risk-free rate data, which I'll show you. And why don't we pull up Research Project 1? Okay. So this is the first research project, which is 15 points. The goal is to make 2 of them, 15 points each, so 30 points total for those. So you'll have one more coming up at some point. I made the due date for 2 weeks from today, the 27th. So assuming we don't have any computer issues, I think that'll be enough time. But I won't give you any more assignments that are due in between. If I do give you an assignment, it'll be due after. So this, uh, once you finish the homework for today, nothing is due
Except for
except this in 2 weeks. nothing is due before this. Okay. So nothing's due next week as well. Okay, so the assignment is, I give you an option here. You're going to write a short research paper. I said roughly 5 pages, but that can be, depending on the number of figures and tables, it can be a bit longer, or it can be, I mean, as long as you do the assignment, there's really I don't want to read 50 pages, but yeah, so I'd say like, yeah, well, you can decide. But once you're getting over 10, then it's going to get long. Okay, or you can prepare a short presentation, and I put roughly 10 slides. So you can do this project as a paper, or you can do it as a presentation. And if you want to do it as a presentation, you got to present it in the class, and it's up to you. So even like, I know that not everyone is here today, but Jordan and Michael, if you wanted to do the presentation, you could. You would just have to like share your screen and kind of take over the meeting. So it's up to you. You have the choice. You don't have to decide right now, but that's the option. So the project has to be completed either as a paper or as a presentation. I don't really care which one you choose. It's up to you. If no one does the presentation, then I probably won't give you the option for presentation next time. But if we get some presentations and students like that, then I'll probably give you the option next time. You want to do a presentation? No? Okay. Well, yeah, I mean, I, if if you're looking at time, it's probably more time consuming to write a paper uh, than it is to do a presentation. But if you write a paper, you don't have to present it. So it's up to you. I put 10 slides, so probably 10 minutes. Yeah.
And part of the presentation, as far as
Yeah.
right now, and still training in the new job.
Yeah.
I think that's
Yeah. And you don't have to tell me right now, but yeah. Okay. Great. I mean, the more presentations, the better. That takes then I don't have to prepare as much for class, and then we can. That's some of the. Okay, so your choice. Um, so whatever you do, you have to. If you use any references, you have to cite them and make a references section or bibliography. Even if you're doing a presentation, just make a references slide. Okay. So the goal of the research project is to first use simple linear regression to analyze the volatility of a stock of your choice, and that's the CAPM, which we just discussed. And the second part is to do some simple forecasting analyses of the stock and examine your findings. Okay, so the project needs to be completed as a research paper or a presentation in class by Saturday, April 27th. And so I'm assuming that most presentations would be on Saturday, April 27th. If uh, if you want to do a presentation and you want to do it next week, you're welcome to do that, but it's up to you. So, if you want to do a presentation and you can't make it next week or in 2 weeks or something, you have that option. But I'm willing to bet that there won't be any presentations next week. But if there is, we can do it. Okay. So what you're going to do under analysis is choose one stock from Yahoo Finance, anything but Google, and then each student's going to choose a different stock. So you need to tell me what you want to choose, and it's like first come, first serve. So you should be able to get your choices out, and then I could maybe get it for Jordan and Michael if they're live, and then everyone else can kind of tell me that at a later date. But I'll post or write what has been chosen. Okay, so start thinking about that because everyone gets a different stock. Okay, and there's plenty of stocks in the world, so it's still a different. Okay, and I'd recommend not choosing something that's super new, like you want at least probably a year of data or so, if not more. But so if don't choose your friend's stock that went public yesterday because you probably don't have enough data to do the analysis. Okay. So part one is do the CAPM, which is going to be to use simple regression to perform a CAPM and interpret your results. And your goal here is to find the beta and tell me what the beta means. Really, that's it. Okay. Part two, we covered most of these last week, but you're going to look at and compare the methods, the simple forecasting methods, and determine which method yields the best 1-year forecast. So I just kind of want to do this as a 1-year forecast. So you're kind of projecting 12 months in the future. So last time we talked about the mean, the naive, the seasonal naive, and the drift. And so you'll compare those methods, and I'll show you how to kind of like compare the accuracy. And whichever one you determine is best, you can present that one. So you're gonna at the end, you're gonna choose one of these four. Okay. And then the second part we also did last week is you're gonna run a regression with the trend and a seasonal dummy variable. So we did that in R, and you can use the same kind of command or code, what have you. So you'll fit a regression line with a trend and seasonal dummy variables to get a 1-year forecast of the stock. And so you're trying to see if your stock has a seasonal aspect. It probably doesn't, but it's possible. And see if there's a trend, which it might. Okay. And then part four, we haven't done this yet, but it's a simple forecasting method in Excel that I like to use, which is to play with the trend lines, and whichever trend line you think is best, kind of by looking at the R squareds, you can just extrapolate that for a number of periods. So this is basically using the trend line methods we did like in the first week. And when you get to the trend line tools, you'll just say forecast for 1 year or whatever. Okay. So those are the four main pieces. Yeah.
But then based on calculation, what do I get off? You have to do.
What-
Awesome. You have to do exactly what we're talking about. And then you and or
Yeah. I mean, okay, we'll get there. So
number one,
yeah.
What you need to start. How many goals
Mhm,
and then I'll look at what
mhm.
and then one minus
Yeah. Right. That's first step. Yep. Well, we'll do it again together. Yeah. Right. Yeah.
This clause we need.
Right.
So we do that,
Yeah.
and then it be transferred, right?
Mhm.
The fourth one is on that.
We haven't done
So just do this for free, right?
Yep.
So after doing for free, then I believe that you think that
Well, okay. So we're here to the suggested section. So I just put, first of all, the word suggested means you don't have to do it. It's just not, it's optional ways to structure it. So you need to have some kind of abstract or introduction or something. Yeah. So like, right. So here's the goal of the project. All right. So you can, summarize how this fits your stock. All right. So you don't have to write, I mean, abstract is the,
we talk about
Yeah, yeah.
And if I'm getting told,
Right? Yeah, yeah. And then literature and background is so first of all, like the abstract is like a paragraph.
yeah.
Yeah. Yeah. And the literature review and background, and this is optional as well, this would also be like a paragraph. So if you use some outside literature, or if you want to introduce, you know, some history, like let's say you choose Apple, and you want to tell me like, you know, some historical facts of why you chose it or whatnot, you would put that here. Okay. Now this is the main part. Okay. So data analysis, really, this is the only part that's required. So you have to have an intro, a conclusion, and then this part. Everything else is anyway. And you don't have to call it abstract. You don't have to call it literature, but you do have to do this part, and you have to. Yes, exactly. Yeah, right. Yep. So data analysis, the meat or the bulk of the exercise is first thing is interpret the CAPM. How does your stock?
Yeah, I look at this.
Yeah, yeah, you're right. I mean, it's like I said, it's probably more time efficient, but I want to give the students the option because I don't want to make you come present if you don't want to.
Not to, but I mean, if you're gonna do research, this is kind of be a good sort of a smaller version of what your dissertations. You know, you're gonna have to do that materials, you're all gonna have to do that in one direction. You don't have this quantitative. Well, you need to keep it all quantitative and have to do this.
Yeah, and so like that's a good point, but for the abstract, so I'll tell you that's like when you do dissertation, that's the one thing you're gonna rewrite 100 times. So I'd recommend that once you have an idea, write an abstract, and then every time you do something, like go back to the abstract and modify it, because it's only like half a page. But every time you do something different, if you forget about it, it's like that. That's almost the most important thing, is it summarizes exactly what you. So that I probably spent 2 years of my life rewording the abstract. So I mean, I'm still not sure. Yeah, yeah, that's what you should. Yeah,
I never had that before.
yeah,
Everything, all the stuff, private. I just have to choose something.
yeah. So okay, yeah, just to finish this up. So you're going to interpret the CAPM. How does your stock compare to the market? Okay. And then what's your best forecasting method and show the results. So all you're doing here is I'll show you how to compare and you'll show me your forecast. Uh, you'll show the findings from the trend and seasonal regression. Uh, are those aspects significant? Like, do you have a significant trend? You might, or seasonal dummy variables, you might, but probably not. Um, and then what's your best trend line forecast? And again, we haven't done this yet, but we have done the trend line. And really all you're doing is making a trend line and sending it forward. So I give you the option to choose like a nonlinear model because it might fit better. You don't really have to understand the equation, but like for example, last week we looked at Goog. I called it Goog, I forgot. Okay, so here's all our data from last time for Google. And we've done this before, insert scatter plot. Okay, and we know how to do a trend line, which is just to hit the chart design, add chart element, trend line, more trend line options. So you can, if you kind of look at, there's different options which might be better fit. So if I hit exponential, that looks like a much better fit than linear. I can try logarithmic. I don't know what that is. That's not it. Polynomial looks pretty good too. Power, eh, moving average. And that's like a, don't use that one because it's like a fake. Or you could, I mean, it's up to you. but so if I wanted to try something like exponential, and let's see if I can get the way you could compare these if you wanted to is oops, sorry. Okay, so if I hit display R squared value in chart, and I can look at different ones. So see, that one's hard to see, but it's 0.78. This one's 0.93, pretty good. This one's 0.4, that's not 0.93, that's close to power. And then this one is something else. So I'd recommend just kind of playing around with these different ones that they have as the default or the options. Power, polynomial, logarithmic, linear, and exponential, and kind of pick which one you want to use. And here at this, I think I like this one the best, just because it looks like it's capturing the movement. But it doesn't capture like this part, but and then what you would do is hit, see where it says forward, and you would just go forward because it's monthly, 12 periods, okay? And then we can get the equation and we can close it. So the forecast is just this part. So based on what's happened, it says we'll keep doing this. So that's it. And then your forecast is what happened these additional periods. Yeah. Okay. And I'll show you how to get you're you're gonna have to use the equation to get the numbers, but it once you get the equation in there, it's not too hard. Okay. Yeah, so yeah, Goog is going up.
Yeah. Alive.
Well, it has.
This is a recent.
This is all of it, right? I mean, I think this is last month, right? I mean, they got their like Google glasses or not? What is the Oct Oculus or whatever it is?
So it, so when I typed in Google
Yeah,
it was alphabet E. And
that's it's
alphabet.
alphabets. Yeah, that's it.
Okay. So in order to get all of that, I would go to all again.
Yeah, yeah. Okay. So see if you like play around with these. Like this looks like a pretty good. It's not perfect, but it's. I mean, it's reasonable. So that's the trend line part, and then the uh, yeah, you take a picture, um, and if you're going to present, you talk about it, and then this part you need to do a table. So you can put any figures and tables you want, and then I want you to include a table that compares the monthly forecast for each of the methods. And so basically, um, an Excel table or whatever table that shows the forecast numbers for 1 year from the simple forecasting method, from the trend and seasonal dummy variable method, and from the trend line method. So like let's say this one, the prediction is, what are these numbers? Like 160. So maybe my predictions from this one are 160, 161, 162. Maybe my predictions from this one are 165, so on, just to compare the numbers. Maybe some of them predicted to go down. Here, you have to get the numbers, you need to write the equation in. Yeah, and extend it a couple periods. No, I wonder if I can just, tell Excel to display them. I know there's a way to do that. It'd probably be easier if I just didn't. Well, no, I see what I mean. Like I want to, if I hover over the bullet points, I can see the numbers, but I want to know what these are. I know the equation, and if I write the equation, I can get it, but it would be simpler if I could just. So what if I just display? s- 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 I don't know what that means.
I can just go and back that one, right from here.
Yeah, but I want to know what. I mean, it's yeah. That's I guess you could, but it's roughly like. Well, here we go. How about this? If I just do like. So which is which? So these are the. This is the time, and this is the values. So I want. Oh, whoops. Oh, that's yeah. That's close enough. Maybe I'll just do fives. See what I mean? So like 155. Anyway, I'll show you how to get the numbers, but these are it's like 155, 156, all the way up to like 165. Yeah. So we either need to find how to display those bullet points, or you have to type in the equation and just extend it for two more or 12 more periods. Okay. All right. And then oops, you're going to conclude, write a little conclusion, again, just like a paragraph. And then if you have any references, make sure you cite them in whatever format you like. Okay? Yeah, everyone knows how to reference things and put. Okay. Okay. Yeah, and that's something you. Well, you have to get the thing.
Every time we like, I tell infection. I mean, look, this is maybe mental, the level of fiction, we do this all the time, you know? So what you have, that's just like, things like, you just,
Well, that's what we're gonna do together, and then you just have to know how to explain it. So that's the gist of it. Not too bad, right? Yeah.
yeah, man.
Yeah, yeah. And again, you know, if you're welcome to do this as a presentation and just kind of organize, sections like this.
It's like,
Yeah, it's good. I mean, if you want to, or you can do both and see which one you like better. If you got,
I mean, if I can do, if I understand, it's like, I can do both.
you can do both.
On a broad, platform, but
Yeah, I mean,
concept is getting it.
yeah, you should. I mean, you should get in the practice of writing the paper and then knowing how to present it because it seems easy to present, but once you especially if you write something long. Let's say you write like a, I don't know how long your dissertation is going to be. You think it's going to be like 100 pages or? Yeah, so presenting 100 pages in 10 slides is hard because you have to really condense. I mean, yeah. My dissertation was like probably 300 pages, and I had to present it in like 20 slides. So it took a lot of chopping down. And even that was like, my advisor was just like, it's too long. Like, keep making it shorter. It's because once you're up there, it's like, it's going to take longer. Like, the less you have up there, the less you're going to get like criticized. So if you have something in your dissertation that's like one section or one part that you're not 100% sure about, don't show that. Take that out of your presentation. Yeah. If you can't like back it up, take it out and hope it doesn't come up. Okay, so would you want to take a quick break? Do you want to start the project? What do you want to do? Quick break? Yeah, let's take a quick break. All right, let's come back at I don't know. Yeah, 2:20. I'll eat some more baklava.
Go grab coffee across the street.
Yeah. Uh, uh, you have two now? Oh, so you have two. Well, you can just do the presentation and make it easier. You can do a presentation. Oh, 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 I see. They, yeah, oh, well, you're getting it.
And then I said, in my real life, how can I use this thing? Job, I had to think
Yeah.
the concept. And this paper writing so far, I got 10 references. I only wrote 2 pages. No, I already wrote. I wrote 2 pages so far of 10 references. I've been working on it since in the past, since I have to spend my time on 4 weeks.
Okay.
I spend on the paper.
What's the paper on?
My paper is on the ethics ethical issues of a school. There's an app for billing. So I had a problem.
Oh, did you?
No one will take it. So
Oh, someone had.
someone. Right. With all the other topics, they told you, but Christina, the one I want is technology, ethics and technology.
Yeah. Well, you can have first pick of your stock. What do you want to choose?
The first, positive of something.
Yeah.
That's what I want.
Well, what stock do you want? You choose your stock.
I'm thinking more of right now as Amazon or Windows,
Windows, Microsoft,
Microsoft, or IBM.
IBM.
What's that for Amazon, Tesla? Tesla is a big of
Tesla's gonna be blown up,
I know.
but that's more fun sometimes.
But Apple was good. Apple was good. Because I myself bought Google.
Oh yeah.
And then my wife sold it and she was something and lost the money. Because I Google because it's slow, okay.
Yeah.
I mean it's fall, it's not fall, it's a bit. It goes up a
Yeah.
little bit. So it's not like it goes down a lot, it doesn't go up a lot. So I feel comfortable with Google.
Right.
My wife is sold my Google and for something else and I love it.
Well, sucks.
That's why I said Google.
Yeah.
So 50 was like, I don't like Disney is all about.
Yeah.
Oh, Motorola. Because bad.
Motorola's?
Yeah.
What are they next to?
This to make phones.
It's a big phone.
Yeah.
They make like headsets.
Yeah, you have like different material.
Yeah. Well, I guess yeah, they do make. I don't know. They still make phones.
Yeah. They did make the laser.
Yeah, the Motorola Razr.
I think by that. I was like,
I had one of those too.
I mean, I've been using Motorola. Big fat one. First it came the big one.
Yeah.
Like in the war. I had it. Like back here. Huge one.
No, I didn't. No.
And then the Motorola came, big one. I got 2. I bought it for $1,000 something. Then it went down. Then what I did, it's expensive. Then I went to the store and said, hey, I lost my phone. I lost my phone. I can afford this like $100 an hour.
Okay.
Half an hour stop, $100. I couldn't afford it. I lost my phone. They said, okay, will you break 3 months? After 3 months, then they said, either you pay a fine or beat of contract or buy a new phone. Yeah. So I could go and buy again a new phone. So I had 2 phones.
Yeah.
So I have 2 Motorola phones that half an hour, $100 that time.
That's crazy.
And then afterwards, Nokia was looking for
Yeah, that-
$9, $150.
Yeah, now it's, you don't even pay by the minute.
Yeah, the BlackBerry came out.
BlackBerry, right?
BlackBerry was huge. If you want a corporate version,
Yeah, I never had a BlackBerry,
either. My sister, yeah, a corporate game.
but I know some people that didn't want to stop using it. I have a friend that,
They love it.
that had it until like a year ago. With all the buttons and
I remember in the case long ago, I didn't be like 40 years ago. At that time, there was the case, like what happened to BlackBerry? They surplus BlackBerry and the price went down. What they did, they just destroyed all BlackBerry because they were selling cheap.
yeah,
Yeah, so they destroyed, they didn't destroy everything, and they're selling.
yeah, they created a shortage.
Company sells cheap, right?
Yeah,
Make money. Then it's the
we want, right. Yeah, they're going for the niche audience.
I mean, I came up with that 20 years. Okay. 20 years with it. The stuff
That's tough. I don't know how you do it.
I'm doing it. Yeah, it comes.
Here comes
Here's the color.
it's all right. Talk about BlackBerry.
Oh, I miss my BlackBerry. That's their own. I think the only people who actually use BlackBerries now are like government officials.
Yeah, I didn't know they were still around.
No, yeah, they are. They tried to they tried to revise everything. They're like, oh, cool, and they came out with like a touchscreen one, and
Yeah. Oh yeah, they remember that. They made like an iPhone version.
yeah,
It didn't do well.
no, it's not.
Just,
No, and I don't think that iPhone titanium is doing too well either. Like I think the cells not
it's supposed to be like indestructible or something.
well titanium.
Yeah.
So it's just status. There's no reason to make a point out of titanium. They're making it out of carbon fiber.
Yeah.
But in any case, I think the cells of it aren't doing what they thought, and they've had a lot of issues with the phone overheating. So
Remember when they first made the long ones? People were like bending them in their pocket.
yeah, yeah, just like like societal trends, like when
Yeah.
the Matrix came out.
Right.
They're like, dude, where did you get that phone that snaps open? I
Yeah.
was like, whatever.
Why can't they just make it so it doesn't crack the screen? That's what everybody wants.
Like, just another crack the screen. You can
Yeah.
spend money.
Or why can't they be waterproof? How is that so hard?
I know OtterBox has waterproof cases that seal everything.
They do?
And if you drop it, it's supposed to be like they have like if you drop it and it cracks, they'll replace the cover and the phone. And they have waterproof cases too that seal everything. And if it gets in it, they'll replace it.
But would they replace it with like an old phone that's with like a burner?
No, they'll like whatever, like, hey, I had an iPhone 15, I'm not gonna give you an iPhone 1.
Because that's what used to happen with like Verizon. They're like, here's your replacement. It's like,
I'm gonna go use the restroom. You go ahead and start. I'm sorry.
go ahead. We'll wait. I mean, we're gonna we'll start the project and finish it. I mean, you can probably do it now, but we'll go through everything. Yeah. Well, first we're gonna start with picking your stock and getting the data, and then we're gonna start with the first one, then we'll keep going. But we're not gonna finish today because yeah, go for it. He doesn't like to.
Let's find out how IBM
You want to do IBM?
Yeah.
All right. So first of all, just let's
Move it, better.
well, you not go to Yahoo. So
Yeah, oh, yeah.
if you go back to week 9, open up, or you can just Google this, but Yahoo Finance,
Yeah, better.
and then search for that IBM. And like usually the one that's first is like this one, equity. The IB, their stock is called IBM. There you go. You want that one? Oh, they're down.
And then put the idea back.
Yeah, and you should get this one. International. I didn't even know that was their name. International Business Machines Corporation.
Wow.
Well, but this graph is like it's fake. Look, it's the axes are from 182 to 185. It's like what is, if you click on the all, it might there you go. That no, it's up. See,
Go all.
yeah, the short chart is doesn't show you anything. So there you go. It's been around since 1962. Yeah, so you're gonna have a lot of data. Just okay. You want IBM? All right. Let me make a little.
By the way, I'm doing the idea.
I'm writing it here. Okay, so Noble chose IBM, FYI. So I'm writing it down here. And
So for every reason when you go to Yahoo Finance, you pick something, click all through everything, it doesn't show me all of the numbers.
well, you have to go to historical data.
Okay, so that's,
Yeah, but you can look at the chart first just to see what it looks like.
every time I've gone to it, it's the past hour, it's been frozen. That's what it's doing on my.
That's not well.
Sorry.
If need be, I can just get it for you and post it.
Okay, well, I know what I wanted.
Okay.
I know what I chose.
What have you chosen?
Ferrari,
Ferrari?
so it's Ferrari NV race.
So, did you see the Ferrari movie with Adam Driver?
No, I have not.
I haven't either. Oops.
I chose Aston Martin too. Martin, but there a lot of companies are.
How do I spell it? F-E,
FERRAR.
this one? Race? Your stock is called Race?
Yeah.
That's great. Sure. Yeah, you can hope for the better. No, they're all equal. I mean, it doesn't make a difference. No. Visa? Okay. So this is the one you want to choose, Brian?
Right.
Ferrari
Yeah.
NV Race.
I typed Lamborghini, but
I'm surprised Ferrari is not owned by some.
Uh, well, Actually, you know what?
Okay, and you want to do Visa? So Visa Inc. Oh, it's just their stock ticker is V. They're not doing bad. Yeah, the first chart is like just the 1 day chart.
We type in one.
Sure. Um, yep. It looks like it's German only.
Even after
Yeah.
that off with their cars. is new.
Yeah.
But no, I will
Stick
I'll
with,
stick with guard.
okay. Okay. All right. And then everyone else, let me know what Jordan or Michael, if you're there, you can, if you know what stock you want, you can tell me or post it to the chat or send an email. But anything but IBM, Ferrari, and Visa. Okay. And I'll keep using Google as a Okay, so first thing we're going to do is now that we've chosen our stock, that was the first thing, we're going to go get the data for it. Okay, so you want to, let me look at one thing real quick. So if you go to week 10, this link here, risk-free rate, is the link for the data for the risk-free rate. Uh, Let me just see what the time frame is, just so we're not.
In a Ferrari is still like Ferrari on the spot start. Enzo Ferrari back in the day almost did it. He didn't do it. So Ferrari is still and meaning was under the spot.
Hmm. I didn't think Ferrari was public in the US because it's Italian. Okay, so the date range for the interest rate variable goes up to March. So basically, you'll be forecasting for, or sorry, this is for the other. So what I want to mention here is this is the range you're going to use. You're going to use within for the CAPM. So because the variable you need for interest rates only goes from 2001 to current, you can't use data older than that because I don't have the same variable. So you can for conciseness, use the same date range for your forecasting, or if you want, you can use all the data to get a kind of a, it's up to you. So either way, you'll need two separate spreadsheets. But yeah, you know what, like let's do two separate pieces because it's nice to use the most recent piece for the forecasting. So we'll do that. Okay, so go to Yahoo Finance, find your stock. So you're going to find IBM and go to historical data. Okay, or you're going to find Ferrari and go to historical data tab, or you're going to find Visa. And go to historical data tab. Okay, and I'm going to use, because we've already used it before, Google as an example. Google. Okay, so click on whichever one you're doing, historical data, not financials. All right, and then you should be able to click on the date range and choose the button that says max, which will give you all the data, hopefully up to this month. Get a max. Sometimes this website's a little funky, but right now it's kind of freezing. Yeah. So note that your date range is likely going to be different than mine unless for some reason your stock went public the very same month as this one. So it should go up to April, but the first date should be different. So yours is going to say like 1962, right?
Yeah.
And then Visa is, what's Visa? Only 2008? And what does Ferrari say? For their first date. So some, like right here, it says something to April.
Oh, October 20th, 2015.
Okay, all right, okay. So Noble, you've got by far the biggest data room. Okay, then switch the tab. The things, the button that says daily. You want to flip that to monthly. Okay, and then wait for it to refresh, and then hit the download button, and that should give you a CSV file of the data. Okay, so open that up. Yeah, download and then open it up. And you should get something like this: date, open, high, low, close, adjusted close volume. Okay, and then we're going to resave this. So everybody got to this point? Yeah, you don't want that.
I didn't get it.
Still downloading? Okay. Yeah, yours is, yep. You didn't do daily, did you?
No.
Oh, good. Okay.
I mean, it's a very niche market. There's not a lot of people that $1 million products use it all.
Yeah, well, that is not very practical. You can't use that to go to the grocery store. You can't even,
They did actually make a brand.
I can imagine. Yeah.
Predominantly through Excel or
I think it's going to do a CSV by default. So just open that up and then we'll
So mine already in Excel.
It did?
Yeah.
Oh, okay.
So now it's like,
Yeah, so if you have this spreadsheet for your stock, well, I was gonna resave mine as Excel, but if yours already did that.
now we do
Okay, so if you got the CSV, you're gonna save as, or, you know,
save it to what?
file, save as. You're gonna save it as a Excel workbook, dot XLSX. Yeah, and then put that where you're gonna find it, or know where to find it.
You can
Oh,
you get mad at that.
well, you're gonna have a separate one for the R part. This is gonna be for the CAPA. So this is, it can be whatever you want. Uh, you can just leave it as CAPA. Okay, so so let's save it. Maybe you want to make a folder for projects so you have everything there or something. So I'm gonna call this Goog. And because this one, I'll just call it capital Goog.
You want different.
Yeah. So what I'll do is I'll have this one capital and then the other one lowercase for the R. So you're gonna have two different spreadsheets at some point. Okay, I'll try to. Okay. Okay.
So now I have two files, right? Maybe I have two files. So
Well, right now you should only have one, right? So um, you saved it as a Excel document, right? Here, I'll come and, so,
maybe
Yes.
now. I mean, we do the different.
Yeah.
The time now is,
well,
don't know how it goes. And we are in the, 2012, 2012, we get accounting. Last night,
when do you drink your coffee?
in the morning.
You shouldn't drink it in the evening. Yeah, I mean, I think after like 6 p.m., like you're gonna you should get rid of caffeine. I drink coffee in the morning. I drink like 6 cups before noon, but then I'm done. Yeah. Oh, well, you have to wear the mask.
Need that. I don't know why they give,
Yeah.
but they can give one month. Maybe I can't do it.
You have to though, right?
I do sometimes.
Oh, okay.
One after a month, I don't like.
Oh, okay. Yeah, I have some friends that have those.
It's not comfortable.
It doesn't, well, I know, but it helps you breathe, right? Yeah, I'm sure it does. Okay, so are we, is everyone at this stage?
Yeah.
Yeah. Are we done with Yahoo Finance? Can we close that out?
Well, you need to get the data for the S&P also. But I was gonna set this up first. So we can do that now, actually, if you want. Well,
S&P?
yeah. Yeah, why don't we go back to Yahoo Finance? And everyone's gonna search for the same thing. If you do S and sign P, this one, S and P, like the and sign, you should see the S&P 500 index here. See? S and P, like the and sign.
And then type.
Yeah, S&P, and then just click on the one that says S&P 500 index. This one. Um,
I don't think. So that's it, like. Oh. No one. No one. And B. There. No one. I've done B. No. He's.
okay, so you can we need it only to match our same date range. So you can either download all of it and kind of cut and paste it, or so why don't we, when we get to S&P 500, let's click on historical data. And if you want to make it easier, you can change the date range to match the date range in your stock. So this is but the max goes back to 1927. You don't need all that because your stock doesn't go back that far. So it's, you only need it up to the certain in the same time frame. So you can change it. For example, I know that my Google stock goes from 9 September 2004. So I'm going to change my date range after it stops refreshing to that date.
And now was since January 1960.
Yeah.
While we were thinking.
Yeah. Unresponsive. Yeah, mine did too. It keeps freezing. Yeah.
Yeah, that's what.
Oh, there we go. Yeah. You know what? Before we did we already do this part? It's still frozen. Okay, so before we do that, I'm going to recommend just taking this date range because you can only do the cap M within the boundaries of the interest rate. So you want this range. Um, June 2001 to March 2024. So for your S&P 500, maybe just choose this range and then we can all have the same range. And then for the, yeah, so June 2001 to March 2024. And I'll come double check, but so let me try to, no, here, do this range instead. You only want to choose from 7 2001 to 3 2024 because I know, but you're gonna have a different range for the forecasting part than you are for the cap M because choose the range, choose this exact range. Choose this thing's not smart. Okay, I'm gonna try to close this. Get back to. Oh no, my little blackboard. Okay. So let me start again. S and B. Yeah, historical data. And then we want to choose this range, 7 2001 to 3 2024. So you can just type it in here for the start date, 07 01 2001 to what did I say? 03 01 2024. Seven, yeah, just put in any number in the, no, you want 0701. 0701 2021 and 0301 2024. No? It's freezing? Yeah, just like this here. 7 0701 2001 0301 2024. The bottom one? 03. There isn't, we haven't got there. That's the future.
Okay.
Okay? 0301 2020 2024.
Start date, right?
0701 2001 is the start date, and then 0301 2024, and then done. Okay, and then hopefully it doesn't freeze. Okay, there it goes.
Um,
What? It didn't work? Yeah, it's that. Yeah,
it's. Uh-huh.
it works. Okay, if it works,
Well, hold on.
It goes from right down to day one, day
yeah. Let's.
Now, are we to go back on our Ferrari chart, certified Ferrari chart, and change the date to match this?
Yes and no, because you want to use all the data you can to do the for now. Yeah, yeah. Okay, so for this one, monthly. Oh, it's frozen again. Okay, so July 1st, 2001 to March 1st, 2024. Yep. And then we wanted to do this historicals, leave it, and then monthly. And if everything goes without a crash, you can. Oh, and there's no download button?
No.
For God's sake.
Yeah, mine, it's, oh. The daily stuff?
No, monthly.
Oh, well, it's not.
It's not letting you. Yeah, it's also not letting you download. Yeah.
Oh,
Okay.
it's
Let's.
just, it's slow, it's fine.
I know, but see, the issue now is it doesn't have a download button. Does yours? So I am going to have to fix this. So why don't we do this? Yeah, let me just set up a template for everyone.
Yeah, I'm.
Yeah. So why don't we go? Let's ignore the S&P for now, and just go back to the all the stock price stuff. So your original data set with like the date, open, high, low, close, adjusted code volume for IBM and Ferrari and Visa. Let's get that set up, and then we'll do the other part. Okay. So let's okay, so the only thing we want from this data set is all the dates and the closing price. Okay. So everything else you can delete from the data set. Yeah, so this is the one with just the stock, your like your IBM, right? You want to delete the open column, the high column, the low column, the adjusted close, and the volume, and just have the close. Oh, you can do that. Yeah. Okay. We can do that. Let's do that. Okay, good idea. Okay, so we'll call this master data, master, and then we'll have another tab, which is working. Okay, and then in your working data tab, you're just going to want the date and the closing price. So I'll come double check here in a second, but you're going to want the date. So I'll just copy and paste the date column.
Take the date and take the everything else, right?
The date and the closing price. The close. So date, so select it all. Control A, or sorry, Control C. Let's paste it here in working. And let's also take the closing price. Control C, and let's paste it here in the working tab. Okay. So we have a master tab with all of the stock data. We have a working tab with just the date and the closing price. Okay.
Let's keep dating for.
Yeah. Yeah. And then if you want, you could, this is, I'll come look at your and make sure we're on the same page here, but all we did is here's the file we downloaded.
So that's
That's the one we got from Yahoo Finance with,
that's fine. So I just have that.
yeah, and then we made a separate tab with just the data from the date and the closing price. Because that's what we're going to use for the analysis. So yeah, you can copy and paste it into the second to a new tab.
Okay, so what's like it up?
Yeah.
So in mine, first, there's two cells.
This is the one. So on top of that, it's copy and paste the date column.
Yeah. Okay, and then with this closing column, this is the stock price for one share in like US dollars. So if you want, you can click on the B column and format it to be currency, so you can see like it's a little bit like this means $3.23, and so on. So it's, see what I mean? I'll make it big. What? Yours is different, yeah. So click on your B column, and then Home tab.
Make it count.
Yeah, format cells,
I mean,
currency. Okay, there you go. It's easier. Yeah. Well, if you do it the shortcut here, it like does some accounting. Yeah.
value, but we make it type of a book. Where is the block?
Yes. I mean, if you want, you don't have to.
What we need to do. But the outside I think it works. Even the fact that I don't buy it to the fact that
Oh, this one?
Yeah.
Yeah, it does something different, right? I did this way.
Okay, I think that would.
Oh, right here?
Yeah. Oh,
This is for currency, right?
Yeah. Okay. So you've got all the dates monthly and all the closing prices historically for your stock, right? Okay. So it should go from whatever date the stock went public, and then the most recent date for every, actually, for this, if you go down to the bottom and you see like two two there's a 4-1 and a 4-12, right?
Yeah, I see.
Yeah.
For one.
Delete the 4-12 because we don't want two observations at the same time. So just, hit the delete button and it's gone. So your stock should go from whatever date it went public up to 4/1/2024. So, okay, so we can start with the trend line portion because we're already at that setup. So why don't we do that? Um, why don't you just select all of your stock, or make sure. Let me see something. Yeah, that works. All right. Okay, so everyone has this tab with the date, the closing price in dollars, and it goes up to 4/1. Okay. Okay. So why don't we make what's it called? Scatter plot, and then we'll do a trend line. Okay. So if you got the date and the closing, if you hit just Control A, that'll select all the data. So Control A, just put the selection anywhere in the around here, and just hit Control A for all, and then Insert tab, and under charts you can do the scatter, like just the regular scatter. Okay. Yeah, just the regular one, the scatter.
Just going one.
Yeah.
Okay.
You're good? That worked? Oh, cool. Okay, great. Okay, and then you should get a graph like this, and just when you have, if you still have the Yahoo Finance page open, it should look similar to what was on there. So if I went back to Goog, I'm just doing like a quality check, and I hit on the Google page all, um, your chart should look something like what, or you see what I mean? Like, see what I mean? Like, this should look similar to that, which it does. You can make it, oh, this one?
no. My God.
Your dots? Oh, you can, well, just like, you could do this, just make it wider, like this. Oh, I see what you're saying. Well, let's choose a different, there's different options. Like, you want the one with smaller dots?
Oh, that's cool.
Yeah, there you go. Okay, so we'll get that. Okay, so now what we're gonna do, so everyone has this? Okay, it looks, the graph looks
Yeah,
like,
this is
let me see.
everything's good to go.
Let me take a look at you.
So I'm just looking at the date range at the bottom. So
Oh, I think it's paragraph on it. This-
oh, but
Oh, let's see.
sure.
Okay. Yeah, mine, well, that's too early. Okay, I guess not a big deal, but I don't know why the date range goes back. Okay,
I can literally just stand it all the way.
yeah, that's okay. Okay, so why don't we click on the chart and you can first give your chart a little title. Call this whatever it is, stock price. So this is Google. Well, this one there's already like a little Um,
But, okay.
yeah, there's like, well, there's like a title here already, right?
Now it would be-
Yeah. So where it says close, you can change that to Google closing price or something like that.
Closing.
Yeah. Okay. And then this is already labeled. You don't actually really need to label the axes because this is obviously dollars and this is obviously the date. So you don't need to put a
double, I can put the price.
okay. Now, why don't we click on the chart? And I'll do it this way because it works for Apple or Mac and Windows. Click on the chart and hit chart design up here. Go to add chart element and scroll down to trend line. And then don't choose it, but scroll down to more options. So
Yeah.
chart design, add chart element, trend line, more trend line options. Okay, now pick one or just click it. All right, and then play around with these options here. So you might want to do exponential, linear doesn't look too, and then if you click on down at the bottom, uh, display R squared on R squared value on chart, it'll tell you the R squared, even though it's hard to see. And then you can kind of see which one gives you the better R squared. So exponential 0.93, linear 0.7, logarithmic 0.7, polynomial 0.93, power 0.93. So you can kind of, whichever one you think kind of fits the data the best, you can go with that one. And then before you select it, um, there's also an option for display equation on chart. And there's also an option for forward, and you can put a 12 in there to forward it for 12 months. Yeah.
This is the only one makes most sense.
Not sure that it did what I wanted it to. Oh, I know. Okay. It didn't. Let's.
Are you looking at one options?
Yeah.
I'm trying to get the highest
Yeah.
as far as the
The highest R squared. But I'm gonna do something a little bit different because it's not giving me the extra line to keep going. So if you do this instead, And sorry for the, if you just graph the closing price, insert, yeah, yeah, just the closing price, insert, or just like do another graph. Yeah, just the closing. So select the closing price column. And then do insert scatter chart. Okay. And then let me see if this works. Uh, chart design, add chart element, trend line,
And this is this one.
more trend line option. Yeah, I'm trying to see if this gives me a what I didn't get from the previous one, because I wanted to get the forward on the graph. It's not doing it. Or is it?
Oh,
I guess it is this time. Yeah, I don't know. I'm just trying to, I'm experimenting on how I want this to work.
no.
Okay, we can stick with the original one. Okay, so we have the graph with the scatter plot and the trend line, right? And then here should be your equation, which you can click on and hit like, you can format it if you want to see this better. Right click, format trend line label, and you can change it to number. And this one might need a few more decimals because it's 0.00. Oh, still, what's going on with this? I put 4, but I still got it. Mine must have like, I'm gonna try 6 now. What's going on with this? Is it just 0?
Yeah.
Can't be right.
Because I mean, mine is, then it's, if I just hit that. Hmm. Yeah.
Oh. Okay, maybe it's just a 0 there, but if it was 0, then the whole thing would be 0. There has to be like a decimal there somewhere. But, under format trendline label. I don't know what's going on. This can't be right. Right?
Um, I, I think it is, this is one decimal, this is, that number is expanding, it's doing the exact same thing on one.
But if this was a 0, then the whole thing would just be 0. Right? 0 times anything is 0, so they can't. Okay, I'm gonna.
Isn't it like, isn't like, in quantum physics, like 0 minus 0, it's like 1 or something? I'm joking, I'm just saying.
No,
Stupid
not at all.
math.
Okay, let's. Sorry, this. I'm trying to get the equation so I can use it, but I'll come. All right. Exponential. I'm gonna do the what's this one? 0.9, 0.93. Okay, maybe I'll do this. I'll do the polynomial. Just so I can. Okay, now if I right click this, format trendline label, number, 2 decimal. There we go. There's a 0.4 somewhere. All right, I'm gonna come look at what you guys got because I confused you probably.
No.
Well, it doesn't. I did whatever this is 6 because I couldn't see the number after the 0. So it has to give mine 0.000004 times x squared. So it depends. Okay.
So these are, that's all. Okay, No, I would just. Oh, I know. Same. Yes.
All right, we'll finish this part and we'll be done for the day. So why don't we're gonna get the prediction from that trend line and see what it is, and then we'll save it, and then we'll come back to the rest of this next time.
This isn't this video, I'm sorry. Yes, how do you highlight it?
Oh, so
Never mind.
okay. Now, why don't we make another column C, and let's call this trend line close or something like that. So this is the trend line of the closing price that you fitted. So trend line close, and what we're going to do is type in this equation once, and then use it to get our forecast. Okay. So trend line close, and why do we first either like control down to the bottom or go down to the bottom where the 4-1 is, and we need to add in. Um, so you're here, and then control down.
Okay.
Yeah. And then what we need to do is manually add in the dates we're going to forecast. So usually Excel can recognize the pattern that you're trying to populate. So if I select like these ones, 2-1, 3-1, and 4-1, and I just take the bottom right corner and start dragging it, I want to predict for a year. So that would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That would go to 4-1, 2025. So you can just autofill those dates that you're going to forecast. So you want to predict 5-1, 6-1, which hasn't happened yet, all the way up to next year's October. I mean, April. Let's say October.
April?
Yeah, April.
Oh.
Yeah, for
So start from 4-1.
Start from 4-1, then your first prediction is for May. Your next one's for June, and all the way up for a year would be next April.
Oh, it just tells you that.
Yeah. Yeah, Excel sometimes is real.
In 2025, right?
Yes, 4/1/2025. $4,000? That could be a problem. Let's. Which you're welcome to use, but that's a lot of data. So, yeah, so you just need to get it.
Okay, so how it's mine.
Oh. It's just that. Yes.
But then you say, I like those. But all I can. I can take one, two, three.
Yeah, do that by.
I don't know what happened. It looks so funny because the number one, 5, 7. I'm getting it. Something's wrong.
We got it. All right, we're out of time, but we can finish this. All right. So all we're gonna do is type in the equation and then autofill. So, you know what? Why don't we save this for next week? Because we need to. Okay, we're supposed to be done at 3:25. Yeah,
It's fun, it's not fun.
okay. All right, let's make sure you save this.
I like food. Yeah.
Make sure you save this. Yeah, yeah. Well, we're gonna work on it again next week. So we'll finish. If we don't finish doing it together next week, then I can give you more time, but I think we should finish. So
What happens? For monthly,
yeah. Okay. All right. I'm gonna stop the recording, Jordan and Michael. So we'll pick up on this next week, and we'll go through the rest of the assignment next week.